In my portfolio and my early investing journey, it would be typical for you guys to see me buying companies that are really slow growing and have ridiculous valuations. So today I'm going to be sharing every holding in my portfolio. I'll be telling you guys where I think they're fairly priced, if I'm looking to buy, sell, or hold, and my future with their holdings. And unlike many big YouTubers like Jeremy, I actually show my portfolio and I do it every month. And in today's video, I'll also be sharing where I potentially messed up on some of my buys. So if you guys appreciate that honesty and transparency, I would greatly appreciate if you guys could hit that subscribe button for me. On this channel, I promote real man's investing, not buying little distribution funds, but actually buying businesses to hold for 40 and 50 years. And with all that out of the way, roll the intro.
Hello, I like money.
Alright, I think it's important to mention here also, I left off two companies, which would be Nike and 3M, and NextEra Energy. The reason I'm doing this is mainly because I couldn't get proper valuations with the current financials that they have and where I think they actually are valued. So I'll be talking about them though individually. Before we get into the companies, I'd like to give my thoughts on valuation overall. Now, me personally, you guys should know by now if you've been watching the channel, I'm a lot more lenient on valuation when it comes to buying great companies than some other investors might be. I am much more willing to buy an amazing company at a fair or premium price than a poor company at a great price. With that said though, over the last 3 or 4 months or so, I definitely came to realize that some of the companies that I bought in my portfolio that are maybe good or okay quality that I bought at a really bad price or a premium. And now I'm starting to regret those. Some quick examples would be Coca-Cola, Pepsi, and Johnson & Johnson. Yes, they're good companies at the end of the day, but I'm only going to get a certain return at the company stage that they're in right now. So I used a discounted cash flow model, which is the DCF model, and the dividend discount model. Now, out of the two of these, I like the DCF one better. It mainly values the company's fundamentals and free cash flow, while the dividend discount model more values the dividends and how they've grown with that. So I'm more looking at the DCF more than the DDM. So then I add those two and I divide it by 2, and that's how I get my buy price. And then I also put in a personal buy price, which impacts like the quality of the company. Do they trade at a premium? Is there a reason they might trade a little higher? And it's where I'm personally looking to add in my situation, which is going to be different from yours. Alright, let's start off with my top holding, which is Microsoft, stock ticker MSFT. For Microsoft, I got a DCF calculation of $356. I was playing around with these also, so I was playing around with the growth estimates. That was mainly the big indicator for the fair price that I came at. With the Microsoft, I came at $356. For the dividend discount model, I got $133. Main reason for this, and if you watched my last video, you know this joke, Microsoft only pays a tiny dividend. But for Microsoft's case, they have a very strong growing dividend, but I do come out at a fair price when it comes to the dividend discount model, the $133, assuming that they continue their 10% annual dividend hike pretty much with their free cash flow. And I get an acceptable buy price of $244.50. Now, me personally, where do I think it's a fair price to buy? In my situation, I already own a boatload of Microsoft, but I think it's an amazing company. If it were to dip it to $300, $310 levels, I would definitely continue nibbling in. Next, we have Apple, and for Apple's DCF model, I got $202.27, and for the dividend discount model, this is kind of funny, I got $23.48, coming in at a quote-unquote acceptable buy price of $112.50. Now, I think this is completely inaccurate due to the dividend discount model. With that said, though, Apple's dividend is pretty poor, especially with their growth rates. Me personally, where would I be looking to buy Apple? Apple already is a pretty sizable holding. With that said, though, if they get in the $160 to $170 range, I will start dollar cost averaging for sure. If Warren Buffett was paying $150 for it, I think at $160, $170 is a good price for me to add. Next, we got Starbucks, and for my Starbucks DCF, I got $101. That's a little above where it's trading at right now, near that $93, $94 mark, and a dividend discount model of $61. That gives me a buy price of $81, which I would probably round up near the $90, $100 range to be fair price. Now, let's keep in mind here, if I were to input that China growth numbers that are expected to go through, that would give me a price at Starbucks at around $120 to $130. With that said, though, China has been a little uncertain these last few years, but if Starbucks can start getting consistent when it comes to the free cash flow department and more growth in China, I think they could be trading at $120 to $130 at fair price coming soon. With that said, where am I personally looking to add Starbucks? If I can get Starbucks below $90, I think that's a really good price to add to. Right now, Starbucks makes up 7 to 8% of my portfolio. Next, we got Visa, stock ticker V, and I was looking at Everything Money in their Visa video just 7 months ago, and this kind of shows, how stupid valuation can be sometimes. They had about a fair price at Visa at like $135, which is absolutely ridiculous to where it's trading at right now. We need to keep in mind companies like Visa that are toll booth companies, traded at a premium. Companies that are consistent like this have amazing qualities. They traded much a higher premium and a much more expected growth rate. So with Visa, I got a DCF model at $252, which is a little above where the trading price is at right now at $234. I got a dividend discount model, $191, and that gives me an acceptable buy price of $221. Now, me personally, where am I looking to buy Visa? $230 to $250 to $60 range. I think that's fair price, absolutely. And I'm very happy to pick up a quality company like Visa at a fair price. This brings me to my next point in the video when it comes to valuation, is how stupid it can be sometimes. You'll see these finance gurus have these really conservative estimates because they're in a different situation than you and me. I'm much younger. I'm willing to pay a fair price or maybe even a premium for a very high quality company like Visa, but a lot of other channels that won't disclose it already have a lot of wealth and they don't want to put a lot of risk or pay a premium for a company just to get a market performance. They want 12, 14, 15% returns year over year, and that's why their estimates are so conservative. Next we got AbbVie, and AbbVie is a company that trades at a bit of a discount because of the Humira patent that expired this year that is going to impact their financials a little bit. But after doing a bit of a deeper dive, I think long term they'll be able to recover just fine from it. I got a DCF of $175 and a dividend discount model of $144, and that gives me a buy price of $159.50. Now, for a company like AbbVie in my portfolio, I already have gains on it, and there appears to be a little bit of a risk when it comes to the long-term dividend growth and how aggressive it could be in the future. So with AbbVie, it would have to go on a pretty decent dip for me to continue adding in my portfolio, and it's a company that I'm kind of reevaluating right now just because of my circle of competence. Pharma obviously is an industry that you want to be invested in because of how dirty it can be at times, which as a shareholder is a pretty good thing. So I mean, I have gains on AbbVie right now, so that definitely plays another factor into it. So it would have to go on a pretty sizable dip. Personally, where would I be looking to buy? I bought some in June at $138, so if we were to get below $130, I'd definitely be a little more interested to buy. With that said, though, I am on gains on the company right now, and I'm kind of reevaluating what I want to do. Next, we got Realty, Not Reality Income. Now, with Realty Income, it's weird because I can't do the DCF model on it because it's a REIT, and you guys will see that. So I did the DDM model, the dividend discount model, which I don't love because simply, basically their entire business and stock is for the dividend, and I got $74.55 on it, which gives me an acceptable buy price of $60 to $70, which you guys can watch my Realty Income video when it comes to the valuation. I did price to AFFO. And that personally, where would I like to buy Realty Income? If it were to get to $45 to $55, I would definitely be a lot more interested to buy. It's dipping a lot right now, which means I could get a possibly decent return over the long term. With that said, though, I don't think Realty Income is going anywhere. Their growth definitely will be limited, though. There are so many companies in my portfolio that I view as higher quality or higher growers over the long term compared to Realty Income. Realty Income is not a bad company whatsoever, but there's going to be only limited growth. So if it continues creeping to that $45 range, I'm definitely going to be a little more enticed to buy. Next, we got Mickey D's, and if you guys haven't already watched my McDonald's stock analysis, I'd highly recommend it. The link will be in the description. I go very deep on the company. I view it as one of the highest quality videos that I've made when it comes to stock analysis. For my DCF, I got $166 on McDonald's, and for my dividend discount model, I got $196, which gives me an acceptable buy price of $181 on McDonald's. Now, McDonald's is a company that is a staple. It's going to consistently produce free cash flows and do buybacks and have everything you want for in a company. Especially with everybody saying we're going into a recession, it's definitely a company that would give you some good leverage against that. Me personally, where would I be looking to start adding to McDonald's? $230 to $240 is where I'd start to look to nibble, but if it were to get below $220, I'd definitely consider loading up. My average cost per share on McDonald's is around $215 right now, so if we get to below that, I'd definitely load up. Next, we got Vici, and Vici is a company that I've been adding to a lot this month, especially with the higher interest rates. With Vici, it continues falling below its intrinsic value, in my opinion. For its intrinsic value on Vici, I have it at $35 to $38 right now. Me personally, where would I be looking to add? If it continues falling, below $28 is ideally where I'd like to continue loading up. I bought some yesterday near $27.58. So right now it's trading above a 6% dividend yield, and I'm happy to lock in that return there, and hopefully over the long term I will get a market-beating performance with my VG. Alright, next we got a good one, and it's Target, of course. So with Target, I came out at a DCF model of $157. Now I averaged the 2022 numbers because right now their free cash flow is technically in the negative, but if you look at their recent quarterly free cash flow, it actually is coming out positive. So if I ran current estimates right now, I'm getting a DCF model at around $157 per share and a dividend discount model of $130 per share. That gives me an acceptable buy price of $144 per share. Now, me personally, where would I think it's fair price to buy Target? I have $150 to $170. Now, I think it's important to mention I ran 2022 free cash flow estimates when it comes to the DCF, and that comes out at $230. I think that 2022 number is very important to mention because that's where they were trading at their all-time high pretty much. So if we kind of average it in, I think I got a pretty solid price at $150 to $170 per share. With that said, right now, the market isn't loving Target, obviously, for some short to medium term reasons, in my opinion. Next, we got Johnson & Johnson. And Johnson & Johnson is a company that's a very mature company, a very large business, and it's actually been a company that I've been considering possibly trimming. I got a DCF model of Johnson & Johnson at $107. I think it's also important to mention, too, that the free cash flow growth has been nothing to write home about whatsoever. And their dividend discount model, I got at $73 per share, assuming that they pretty much continue their annual 4% dividend hike. That comes out an acceptable buy price of only $90 compared to where it's trading at right now at $153. With that said, though, where would Johnson & Johnson have to fall for me to continue adding? $120 to $140 I think is reasonable considering the kind of company they are with the premium that they're going to trade at. With that said, though, looking at that right now, Johnson & Johnson is trading at a pretty premium price, and my cost per share on Johnson & Johnson is pretty high. If it were to fall to $120 to $130, I would definitely consider adding, but right now I'm considering trimming. Speaking of trimming, the next company is Coca-Cola, stock ticker KO. With Coca-Cola, I got a DCF model of $33.50 and a dividend discount model of $28.02. That comes out to an acceptable buy price of $30. With Coke, they obviously traded a premium, and they've been trading at a premium for a while with low volatility. So with Coke, if it were to fall to $40 to $45, I think that's where I'd consider potentially re-entering. But if you guys want to see what I potentially did or did not do with my Coca-Cola stock, watch the portfolio update next week. Next we have Altria, stock ticker MO, and Altria is another company that always trades at a discount simply because of the industry and the tobacco, the industry that they're in. Not a lot of people want to be invested in it for the long term because of the declining smoking rates and so many more risks that are associated with it. With Altria, I also put very conservative estimates when it comes to the growth rate of the dividend, free cash flow, and all that, simply because of the business that they're in. Even though with all that, it proves my point that they are trading at a bit of a discount right now. I got a DCF of $52.07, a dividend discount model, which obviously is going to be a little more favorable because of their very strong dividend at $55.76, giving me a fair price of $53.50. Right now with my Altria, I'm not buying any, I'm just reinvesting my dividends, as I do think they are at a bit of a cheap price, but I don't want to have it be a core position in my portfolio, and I already own enough where I'm happy at. So it would have to fall to $35 to $40 for me to continue adding, but I will be reinvesting my dividends right now at these cheaper prices. Next we have Kroger, stock ticker KR, and Kroger's weird because the free cash flow has taken a significant dip this year. I'm alluding this mainly to some of the inflation and the Albertsons merger that's going to be going through, but I got a DCF model of the recent calculations that I did on the quarterly free cash flow of $64 and a dividend discount model of $47. That gives me a fair price of Kroger at $56. Now, Kroger is a company that I wouldn't consider A or S tier, so I'm going to be a little more conservative, but I would like to add Kroger the $40 to $45 range. I think I get a really solid return over the long term with that. So if Kroger trades in the low 40s, don't be surprised if you see me buying some more. Next we got Union Pacific, the railroad giant, and with UNP, I get a DCF model of $247 and a dividend discount model of $232, giving me an acceptable buy price of $240. Now with UNP, I put in a little more aggressive growth rates as the new CEO, Jim Vena, is expected to accelerate growth of the company, especially with a company like Union Pacific that's already had very strong growth rates in the past. I find it crazy that they have even more growth ahead of them, even with the strong growth rates that they've had in the past. The fact that there's even more potential for a company like Union Pacific in the industry that they're in right now is pretty crazy. With UNP, if I can get it near $200, I'd be a very happy shareholder. Next we have Disney. Now with Disney, we obviously can't do the dividend discount model, but I did the DCF model, and I put in a little more conservative estimates, assuming that streaming becomes profitable in 2024, and I got $115 per share for my DCF model. So where am I personally looking at? If I can get it below $110, but I'm not touching Disney right now due to all the risks and the better opportunities that I see over the long term. With Disney, it's weird because I still believe that over the long term they can recover, but I don't want to put any of my capital on it right now because all the better opportunities that I do see over them. Next we have Pepsi, and Pepsi I got a DCF model of $110, an acceptable buy price of $107. So where would I personally be looking to add with Pepsi? I have a cost per share on Pepsi of $140 right now, so if Pepsi were to go to $120 or $130, I would probably add some more. With that said, though, they are trading at a crazy premium right now, and their payout ratio is getting a little high, so is a candidate to be potentially trimmed. Next, we got UPS, and with UPS, it's really a weird position in my portfolio right now, because it's not a huge sizing in my portfolio right now, but it's also not a really small position. I have a bull case on it, I have a hold case on it, and I have a sell case, so it's in a really unique circumstance in my portfolio. They also have a very strong track record of repurchasing shares and rewarding shareholders through great dividends and share buybacks. If you look at them historically, they're very strong when it comes to that department. Also, they just reached a union agreement with their workers, and they're going to be paying their workers like $150,000 a year, which is insane. Obviously, I don't think that's great for the short-term health of the dividend growth. It's a bit of a goosebump in my portfolio right now, and I'm kind of reevaluating constantly right now. I really don't know what I want to do with it. But I got a fair price at $187. And me personally, where would I have to go to add? If it got below $140, realistically, I'd probably add more. Next, we got NextEra Energy, and it's another one of those companies. It's a goosebump in my portfolio. I have a buy, sell, and hold thesis for all of it, so I really don't know what I'm doing with right now. Next, we got Texas Roadhouse, which I got a DCF model of $115.71 and a dividend discount of $98.20. Give me an acceptable buy price of actually where my cost per share is at right now at $106. Now, me personally, where would I like to buy Texas Roadhouse? Below 105 I think is good, and I like it at these current prices right now. The reason I haven't really been adding is because I can't do fractional shares with Texas Roadhouse because it's not in the S&P 500. Shame on you, Schwab. So with Texas Roadhouse, I'm probably going to be eventually adding soon if I can get it below $94, $93 for me to buy a whole share. Next, we got Costco, and for Costco, I got a DCF model of $447 and a dividend discount model of $182, not including the special dividends they do. That gives me an acceptable buy price of $315, way below the current trading price. They obviously traded a premium, but I will be dollar cost averaging $25 every week in a Costco below $540. My cost per share in Costco right now is at around $525, which is pretty sizable compared to where it's trading right now at $560. So if Costco ever trades below $540, I'll put $25 into it just to build up in my portfolio, but I would definitely be loading up if they went on a pretty sizable dip of 12 to 15%, which in the near future, I don't think it will happen. And lastly, for my newest holding, S&P Global, I got a DCF of $570 and a dividend discount model of $294, giving me an acceptable buy price of $432. Me personally, where do I think it's fair price? $390 to $400. I think it's very fair price for the type of quality company they are. So I've been chipping away at S&P Global at these prices and the type of dip they've been on. A lot of people are worrying about a recession right now, which is the best time to add to these kind of companies. And the two companies that I mentioned at the beginning of the video, 3M and Nike. With 3M, I found it very hard right now, especially with the current lawsuits and how that's going to impact their free cash flow to find an estimate. And it's also a company that I'm not too willing to add to my portfolio right now, but I got fair price at around $80 to $90 for that with the current estimates going in the future. And with Nike, I got some ridiculous fair price of like $40 or $50. So with Nike, I'm looking at it if it goes below $90, and I did just last month. Check out my September portfolio update if you haven't already. And that's the end of the video, guys. If you appreciate the transparency, me sharing my thoughts, thesis on every company in my portfolio, and the time that I put into making this spreadsheet, I would greatly appreciate if you could hit that subscribe button for me. Become a channel member today for exclusive perks and so many more awesome benefits. The links in the description. Thank you all, and of course, do dividend stocks, not drugs. Have a good one.